Hey everyone, and welcome back for another deep dive.
Yeah.
So today we're going to try to build a solid investment system.
Right.
And, that can be kind of daunting, but we're going to be talking with, learning from Dimitri Uralov,
Okay.
who's this financial investor entrepreneur.
Interesting.
And he has this YouTube video where he lays out this framework,
Mm-hmm.
and it's surprisingly simple.
Okay.
And he says anyone can use it.
Right.
Whether you're into real estate stocks, even those collectible cars.
Mm-hmm.
So
What I think is so interesting about it is
Yeah.
it all boils down to these three fundamental questions
Okay.
you should ask yourself before you invest in anything.
Right.
It really helps you cut through all the noise,
Mhm.
focus on what matters.
All right, so let's dive into these questions.
Yeah.
The first one is, what are you looking for?
Right?
It seems pretty straightforward,
Mm.
but I have a feeling there's more to it.
Yeah. You're totally right.
Yeah.
It's easy to just get caught up in the potential of an investment.
Right.
But if you don't have a clear idea of what you're actually looking for,
Yeah.
you might make a decision
Yeah,
that you regret.
like an impulse buy.
Yes, exactly.
Yeah.
Like going to the grocery store without a list.
Yeah, you end up with a cart full of snacks and no dinner.
Exactly. Uralov, he uses some great examples
Okay.
to illustrate this.
Yeah.
Let's say you're interested in stocks.
Okay.
What kind of companies are you looking for?
Mhm.
Are you looking for ones with consistent dividends,
Right.
strong financials, low debt,
Okay.
stable management?
Yeah, those are all good things.
Yes.
Those are things you need to know up front.
Yeah.
And it's not just stocks, right?
No, it's not just stocks. This
Huh.
applies to everything.
Okay, so any asset class.
Any asset class. So let's say real estate.
Okay.
Are you focusing on specific neighborhoods?
Right.
Are you looking for properties with good rental income?
Yeah.
High potential for appreciation?
Mm-hmm.
Or maybe you're interested in lending money.
Okay, yeah.
You want to consider the borrower's creditworthiness.
Right, they're collateral.
Exactly.
Yeah.
The track record of repaying.
So essentially, this first question is all about setting your criteria,
Yes.
creating a filter,
Mm-hmm.
zero in on the ones that fit your goals.
Precisely.
Okay.
So once you have a grasp on what you're looking for,
Okay.
we can move to a second question,
All right.
which is all about the price.
Okay, here's where it gets interesting for me.
Okay.
What's the right price to pay?
Oh, the $1 million question.
Even if it checks all the boxes.
Right.
How do I know I'm getting a good deal?
This is where the concept of value investing comes in.
Okay.
Uralov emphasizes the importance of figuring out your target price,
All right.
which is a maximum amount you're willing to pay for something
Okay.
based on what it's worth.
So how do you figure out the target price?
So there are a few different methods,
Mm-hmm.
and the best one really depends
Okay.
on what you're considering. Okay. Like if you're looking at stocks, you might want to consider things
Yeah.
like the company's price to earnings ratio
Okay.
or the dividend yield.
Hold on. Price to earnings ratio.
Yes.
Can we break that down?
Yes.
For
No.
people who don't know?
The price to earnings ratio, or the PE ratio,
Okay.
is basically a measure of how much investors are willing to pay
Okay.
for every dollar of earnings.
Okay.
So a high PE ratio
Yeah.
could mean that people are optimistic about the company. And a low one might suggest that it's undervalued.
Okay.
It's not the only thing to consider, but
Yeah.
it can give you a sense
But
of
it can-
whether the price is reasonable.
Got it.
Okay.
So how does this help us determine the price?
You can compare the PE ratio of the company to the average PE ratio
Okay.
of similar companies.
Okay.
So if the one you're looking at has a much higher PE ratio,
Yeah.
it might be overvalued.
Right.
And if it's lower,
Yeah.
it could be a bargain.
All right. So we're doing some detective work.
Yes.
What about real estate?
Real estate can be a little more complex,
Yeah.
but one common approach is to use the income approach.
Okay.
So this is about figuring out how much income the property can bring in.
Okay.
So we call this net operating income, or NOI.
Okay. I remember
Yeah.
NOI.
Yes.
So it's the profit the property generates
Yes.
after you take out things like taxes, insurance, maintenance costs.
We got it.
Okay. So the higher the NOI, the more profitable.
Exactly.
Okay.
So once you have a good estimate,
Okay.
you can use a capitalization rate or a cap rate.
Okay. I've heard of cap rates,
Yeah.
but I'm not entirely sure how they work.
So it's basically a measure
Right.
of the expected rate of return
Right.
on a real estate investment.
So like the percentage you would earn.
Yes. Think of it as the percentage return you would get
Okay.
if you paid cash for it.
Okay.
So a higher cap rate usually means
Yeah.
a higher potential return,
Mm-hmm.
but cap rates are influenced by all sorts of things.
Okay.
Like the location, the condition of the property,
Mm.
local market conditions,
Right.
how risky the investment is.
Okay.
So to determine the cap rate for a specific property,
Yeah. How do you do that?
you can research cap rates for similar properties.
Oh, so like comps.
Exactly.
Okay.
That have sold recently in the same area.
Okay, so that gives you like a benchmark.
Exactly.
Yeah.
So if similar properties are selling
Okay.
at a cap rate of, say, 5%,
Right.
you could use that
Okay.
as a starting point.
Got it.
And here's where it gets interesting.
All right.
Uralov emphasizes margin of safety.
Okay.
Basically buying it for less
Okay.
than it's worth
Yeah.
to give you a cushion.
Right. So if your calculations are off
Exactly.
or the market takes a downturn.
Like driving down a winding road at night,
Okay.
you want to leave some space
Yeah.
between you and the car in front.
In case something happens.
Exactly.
Right.
It helps you avoid crashing.
Yeah. That's good advice.
So
So we've talked about the criteria, how much to pay.
mhm.
What's the third question?
The third question is your exit strategy.
Oh,
When will you sell?
see, this is where I think a lot of people stumble,
Yes.
including myself.
It's easy to get caught up.
Yeah, we get so caught up in buying that we don't think about selling.
Exactly. And having a clear exit strategy is so important.
All right. So how do we define our exit strategy?
Well, first, you define what success looks like.
Okay.
What are your goals?
Mm-hmm.
Are you hoping for a certain return on your investment?
Go up.
Are you looking for cash flow?
Right.
Or are you just aiming to hold on for a certain amount of time?
So like setting a finish line.
Exactly.
But what if things don't go according to plan?
That's where the concept of stop-loss levels comes in.
Stop loss levels, what are those?
A stop-loss level
Yeah.
is a price point where you'll sell something
Okay.
to limit your losses.
Okay.
So let's say you buy a stock for $100
Mm-hmm.
and you set a stop-loss order at $90.
Okay.
If the price drops to 90,
Your
Yeah.
order is executed
okay.
and you sell.
So it limits the loss to $10.
Exactly.
Okay, so it prevents a small loss from becoming huge.
Precisely. It helps you take out the emotion
Okay,
and stick to the plan.
right.
Now, sometimes you have time-based exits,
Okay,
especially if the investment isn't going as expected
okay.
or market conditions change.
Can you give me an example?
Sure, imagine you're holding a stock that's been doing nothing for years.
Okay,
It hasn't hit your stop loss, but it's not growing either.
right.
You might just cut your losses
Mm-hmm.
and move on.
So being adaptable,
Exactly.
recognizing when things might not be valid anymore.
Exactly. And sometimes your personal circumstances change
Okay,
or your financial goals.
right.
And so you might need to adjust.
So to make sure we're all on the same page.
Yeah.
These three questions are the whole framework.
You got it.
What are you looking for? What price will you pay? When will you sell?
And the best part
Yeah.
is that it can be applied to anything, right? So real estate, stocks, bonds, or that vintage car.
Yeah,
And it's not just for seasoned investors.
absolutely.
Even if you're just starting out.
This can help you avoid the common pitfalls.
Right.
Now, before we wrap up,
Yeah.
we'd like to leave you with something to think about.
Okay.
Think back to an investment you've made,
Hmm.
whether it was a success or not.
Okay.
Did you have these answers before you made that investment?
Ooh, that's a good question to
Yes.
think about.
We'll be back
Yes, we'll be back
in a moment.
to dive into some questions you've sent in
Yes.
and explore some real-world examples.
Yes.
So stay tuned. Welcome back, everyone. I'm excited to dig into some of the questions
Yeah.
that you've sent in about building this investment system.
Yes, let's jump right in. We got a great question from Sarah,
Okay.
who asks, how do I actually determine what price I'm willing to pay?
Right.
I'm especially interested in real estate.
Yeah, that's a question a lot of us grapple with, Sarah. Figuring out that right price can feel like a maze.
Yeah, it's definitely important to do your due diligence.
Mhm.
Remember intrinsic value.
Yeah.
It's about figuring out what a property is truly worth
Right.
based on its potential, to generate income or appreciate in value.
So we're not just looking at the sticker price. We're like doing detective work.
Exactly. There are different methods you can use,
Okay.
but a common one is the income approach.
Okay.
We talked about this briefly before,
Yeah.
but let's dive a bit deeper.
Okay.
It involves estimating the net operating income, or NOI.
Okay, I remember NOI.
Yeah.
It's the profit a property generates.
Yeah.
After you deduct those operating expenses,
Yeah.
like property taxes,
Mhm.
insurance, maintenance costs.
You got it.
Right.
Now, once you have a solid estimate of that,
Okay.
you can use a capitalization rate
Okay.
or a cap rate.
All right. I've heard of cap rates,
Yeah.
but they're still a little fuzzy.
I can see why.
Yeah.
Think of it as like a quick way
Okay.
to assess the return. It's the rate of return you could expect
Okay.
if you paid cash for the property.
So a higher cap rate generally means a higher potential return.
Yeah, that's the general idea.
Okay.
But cap rates are influenced by all sorts of things.
Right.
The location.
Yeah, of course.
A property in a hot neighborhood might have a lower cap rate.
Right, because investors are willing to accept a lower return
Exactly.
to get in on a booming market.
Yeah.
What about the condition of the property?
The condition also matters.
Okay.
A property that needs a lot of work
Yeah,
will likely have a higher cap rate.
because there's more risk.
Exactly.
Okay, so how do we figure out the cap rate?
A good way to start
Yeah.
is by researching the cap rates for similar properties.
Oh, so like looking at the comps.
Exactly,
Right,
that
right.
have recently sold in the same area.
So you get a benchmark.
Precisely.
Okay, so let's say I've done that and found a few comparable properties
Okay.
that have sold recently
Mm-hmm.
with a cap rate around 5%.
Oh.
How do I use that information to determine my target price?
So let's say the property has an NOI
Yeah.
of $10,000 per year.
Okay.
To estimate the value,
Yeah.
you would divide the NOI by the cap rate.
Okay.
So in this case,
Yeah.
10,000 divided by 0.05,
Okay.
which gives you an estimated value
Okay.
of $200,000.
So if I can get the property for less than $200,000,
Yeah,
I'm getting a pretty good deal.
that's the general idea.
Okay.
But remember,
Oh.
margin of safety.
Yes, the safety net.
Exactly.
So even if it's worth 200,000,
Yeah,
I might only want to pay like 180 or 190
that's smart thinking.
just to give myself some wiggle room.
Remember, real estate markets are unpredictable,
Yeah, for sure.
and expenses can pop up.
That's a great tip, Sarah. Thanks for the question.
Yeah,
We have another great question here from David,
okay.
who asks, how do I determine when to sell a stock?
Oh, that's a good question.
It seems like there's so much conflicting advice out there.
Yeah, David, you hit on a point that trips up a lot of people.
Right.
The stock market can be so noisy.
It really can.
It's easy to get swayed.
Yeah, by headlines and experts.
Exactly.
So how do we cut through all that?
Remember Uralov's third question?
When will you sell?
Yeah, it's not just about buying low and selling high.
Yeah.
It's about having that exit strategy
Right.
before you even buy.
Okay, so we talked about defining our goals for the investment
Yes.
and setting stop loss levels
It
that
is
limit
this.
losses.
Let's say you're investing in a growth stock,
Okay.
a company that's expected to grow its earnings really fast.
Yeah.
You might decide to sell
Okay.
when the company's price to earnings ratio
Okay.
or PE ratio gets too high.
Hold on. Can we remind folks what the PE ratio is?
Yeah, of course, the PE ratio is basically a measure
Okay.
of how much investors are willing to pay for every dollar of a company's earnings.
Okay.
A high PE ratio could mean that the market is really optimistic
Okay.
about future growth,
Right.
but it could also mean the stock is overvalued.
So if the PE ratio starts climbing a lot higher
Yes.
than similar companies?
Yeah, it's like a popularity contest. If
Quite.
everyone wants it,
Yeah.
the price can get crazy.
Okay, so we need a rule
Yes.
to sell when it reaches a certain level.
To avoid getting caught up in the hype
Okay.
and selling at a peak.
Okay, now what if you're investing in a value stock,
Okay.
a company that's undervalued?
Right. But it has good fundamentals.
Right. And it could turn things around.
Then your exit strategy might be different.
Okay.
You might sell when the fundamentals start to improve
Okay.
and the stock price starts to reflect its true value.
So we're not just reacting to the market.
Sure.
We're making decisions
Yes.
based on the company.
Exactly. And remember, stop loss levels can be used for both.
Right. The safety net.
They protect you from unexpected downturns.
Okay, so if we buy a stock at $50 a share,
And-
we might set a stop loss at 45
That's common.
to limit the loss to 10%.
And of course, the level you choose
Yeah.
will depend on your risk tolerance.
Right. And how volatile the stock is.
Exactly. It's all about finding the right balance
Yeah.
between limiting losses and letting your investment ride out the ups and downs.
So there's no one-size-fits-all answer
You're
for setting these stop loss levels.
It's best to think about your individual circumstances, your risk tolerance, the characteristics of the stocks.
David, I hope that gives you a clearer picture.
Yeah.
It's not about following the herd
No.
or reacting to every little thing.
It's about having a strategy
Right.
that aligns with your goals
Right.
and your risk tolerance.
And sometimes the best decision is to do nothing.
Exactly. Patience is often rewarded in the market,
Right.
especially if you've invested in good companies
Right.
with a good track record.
We've talked a lot about stocks and real estate,
Yes.
but does this apply to other things?
Yes.
Like collectible cars.
Yeah, the great thing about this framework
Yeah.
is that it can adapt to
Adapt to-
just about anything.
Okay, pretend I'm in the market for a classic car.
Okay.
Walk me through it.
First, you apply Uralov's first question.
Okay.
What are you looking for?
All right.
Are you drawn to a certain model?
Okay.
Are you looking for something pristine
Okay.
or a project car?
I'd want a car in good condition.
Okay.
Something I can drive
Right.
without having to spend months restoring it.
All right, so you've set your criteria.
Okay.
Now for the second question.
What price will I pay?
Exactly. You need to do your research to figure out the fair market value.
Right.
You can check online auction sites, publications, talk to experts.
So it's like checking the Kelly Blue Book for classic cars.
Exactly.
Yeah.
And just like anything else, you want that margin of safety.
Yes.
You never know what issues it might have.
Okay.
So factor in those potential costs. And then the third question.
When will you sell?
Right. I imagine the exit strategy is a bit different.
Yeah.
You might decide to sell when it hits a certain value.
Okay.
Or when you're ready for something new.
Right.
You could sell if the maintenance costs get too high.
Yeah.
Or if your circumstances change.
So just like anything else.
Yes.
A clear exit strategy before you buy.
Precisely. Uralov's framework is great for thinking about any investment.
This has been a really enlightening discussion.
Yeah.
I feel like I'm starting to see
Me too.
how we can apply this.
Yeah, it's amazing how 3 simple questions can really help us make smart decisions.
We've covered a lot,
We have.
and I'm sure our listeners have more questions.
We do have time for one more.
Okay.
This one's from Maria, who asks, I'm just starting with investing, and this all seems overwhelming.
Right.
Any tips for beginners?
That's a great question, Maria.
Yeah.
It's natural to feel overwhelmed when you're starting out.
Right. There's so much to learn.
Yeah.
It's hard to know where to begin.
So what's your advice?
One of the best things I can say is to start small.
Okay.
Focus on the basics. Don't try to time the market.
So start with something familiar.
Exactly.
And build your knowledge from there.
You could consider investing in a low-cost index fund that tracks the S&P 500.
Index funds are great for beginners.
Yeah.
Because they offer diversification.
Right.
And a low-risk way to get into the market.
And remember, investing is a marathon, not a sprint.
Right.
It's about making those consistent contributions and letting compounding work its magic.
Patience and consistency are key.
Absolutely.
Especially when you're starting out.
And don't be afraid to ask for guidance.
Yeah.
There are tons of books, websites, courses.
That can help you learn. Great advice. Even experienced investors need that.
Absolutely. There's always more to learn.
Maria, I hope that helps.
Yeah.
Everyone starts somewhere. Take your time.
Do your research.
Ask questions.
Ask questions.
Fantastic advice.
Yeah.
We'll be back in a moment.
Yes.
To wrap up
our deep dive
into this investment system.
Stay tuned.
Wow, what a deep dive this has been.
I know, right?
We've explored Dimitri Uralov's framework for building this investment system.
Yeah.
And we tackled some great questions.
Yeah. It's really amazing
from our listeners.
how those 3 questions can provide so much clarity.
Like, what are you looking for?
Yeah.
What price will you pay?
When will you sell?
Right. And it can help you.
With any investment decision.
Yeah, it's like having a roadmap for navigating this crazy world of investing.
And the best part is you can apply it to anything.
Right. Stocks, real estate, even classic cars.
Exactly. It's about moving away from those emotional decisions to a more strategic approach.
So you define your criteria up front.
Yes.
You figure out the value. You have a clear exit strategy.
That's how you increase your chances.
Right. It's like taking out the guesswork.
Yeah, and replacing it with a plan.
But even with the best system, there's one thing we haven't talked about.
What's that?
The human factor.
Oh, you're so right.
Our emotions can really mess things up.
Yeah, our emotions can lead us to make bad choices.
Especially when it comes to investing.
Yeah.
Fear and greed,
they can cloud our judgment.
Big time. Especially when the markets are all over the place.
Exactly, like we might get too excited during a bull market and buy a bunch of stuff.
Or we panic and sell everything.
When the market dips.
Yeah, so how do we keep our emotions in check?
That's the question.
So they don't sabotage our plan.
One thing that helps is to have a written plan that outlines your goals, your risk tolerance, your strategy.
So it's like a set of rules
to
follow when things get crazy.
Another tip is to diversify.
Diversification.
Don't put all your eggs in one basket.
Right. Spread your investments around.
To reduce your risk.
And smooth out those ups and downs.
Exactly.
That's classic advice.
That's so important.
It really is. It helps us survive
those market storms
without going broke.
And finally, remember, investing is long-term.
Okay.
Don't get discouraged by those little changes.
Right.
Stick to your plan.
Stay disciplined.
Focus on the big picture.
Have that long-term vision.
Investing is a journey,
not a destination.
There'll be bumps, but with a good plan, you can achieve those goals.
This has been an amazing deep dive.
I agree.
I hope our listeners feel empowered.
Me too.
To take control
of their financial future.
And start building their own systems.
Remember, it's about taking that first step.
Right.
And then just keep learning.
And don't forget to enjoy the ride.
Yeah. Investing can be tough.
But it can also be so rewarding.
Thanks for joining us.
We'll see you next time for another deep dive.
Into the world of knowledge.
And ideas